Hello, chart watchers, and welcome to this Tuesday, August 27th, 2019 Market Watchers live show with your host, Tom Bowley and Erin Swinlin. For those of you joining us for the first time today, welcome to the show, and for regulars, welcome back. Well, the upside move that we saw yesterday and a little bit of strength we saw earlier this morning seems to be falling by the wayside a bit. Currently, we got the Dow Jones Industrial Average down 41 points, the S&P 500 down 3, the NASDAQ down 12, and the Russell 2000 down 11. Once again, on a relative basis, underperforming. You can see we're very close to another breakdown on the small caps. The others have a little bit more room, at least to negotiate. We'll see whether or not they get closer as the day moves on. 10-year Treasury yield continuing its slide to the downside, down more than 6 basis points again today, back to 1.48%. We're not quite as low as we were about 10 days ago, but this would be the lowest close that we have seen in quite some time. Volatility index continuing to remain somewhat high, and this had me a little nervous yesterday. Still think there's the possibility in the short term we get another push to the downside, and I'd really be watching the support levels that were established earlier in August, because if those go with the volatility index where it is, it could be another swift selling episode, so just keep that in mind. Leading today, real estate breaking out to a new high, which is awesome if you're in that space. Communication services, not exactly the same type of situation here. In a downtrend, it is up today, but it's got some overhead resistance trying to clear. Utilities like real estate also doing well, breaking out to new highs here. Financials, this has been one of the weakest areas of the market, and it's understandable with the 10-year Treasury yield continuing to move lower. Financials not far from another breakdown, just a little below $26. I'd watch that level pretty closely. You can see the food group making a breakout here. This is in consumer staples. Really nice pattern. I think the chart came back up. We tried to get through 480, consolidated for a couple days, now making a nice breakout. Banks and life insurance, though, leading the financials to the downside. Banks not far from a breakdown. Life insurance actually making another breakdown. Want to be careful in this area. Costco, they did open their first mainland store in China, and apparently lines were pretty far, pretty deep. And as a result, Costco, you can see making a breakout on that news. Smucker's in the food area as well, not having such luck. Smucker's came through with a pretty dismal earnings report. I'm going to pull that chart up in a little bit and take a look at it. But they missed on their top line, missed on their bottom line, and then lowered fiscal year 20 guidance. So real trifecta for the Bears there. But Smucker's had not been performing very well. We'll take a look at that relative chart in just a bit. All right, Erin, it is Tuesday. And it's workshop day.
Yes, we had to remind you earlier today that it was Tuesday and not Wednesday.
I was ready to welcome in Jesse Felder.
Yes, exactly. I was like, nope, surprise, you have a workshop today that I know everybody can't wait to see.
Yeah, that'll be fun. But what do you think of this market? I mean, it's a yo-yo. We're back down again.
Oh, it's just that volatility we keep talking about, which is why I'm watching my positions very closely right now. What a surprise, though, right? I woke up and was looking at the numbers and, oh, good, we're getting a nice bounce. And then, my gosh, I'm looking at these 2-day charts. Oof.
Yeah.
It's pretty tough after that open.
Yeah, and volatility is still up there. I mean, volatility is sitting at 20. It's not like it's down at 12.
No, so exactly.
Anytime, you get that volatility up there. Anytime you get it up that high and the market loses a price support, you want to be really careful. Make sure you have stops in play, because we know how quickly the market can sell off.
Exactly. And I generally don't have my hand on the wheel looking at my charts every day, but I have been doing that as of late. So far, my positions are looking pretty good, but, I got to keep an eye on them.
Absolutely. And, when you're looking at the market, it depends on your time frame. From a longer term perspective, personally, I'm not that concerned about what's going on. I think it's a lot of manipulation back and forth. Volatility's high, but in the short term, if you're a short-term trader, I think you've got to have your, one finger on the pulse of this market, and volatility plays a big role in it. So you got to watch if support fails to hold.
Exactly.
All right, what do we got today?
All right. Well, our upcoming schedule, as we hinted at earlier, Jesse Felder will be in tomorrow as our special guest. Tom, you're back on the on the hot seat with the seasonality report coming up on Thursday. And then, of course, Labor Day is arriving and the market will be closed. And we have Linda Raschke coming in next Wednesday. So really excited to talk to her again. She's a lot of fun. Today's agenda, of course, as we said, Tom's going to be doing a workshop on identifying a relative strength process. So I think that will be very interesting for everybody. I'm going to end up doing the 10 and 10 today. Tom will give me the symbols. First one is going to be Dropbox. So go take a look at it and I will show you how to annotate. All right, let's get started with the technical news and headlines right now.
All right, we're going to jump into the economic reports this morning. Case-Shiller home price index came in flat. Market was expecting a rise of 0.2%. And then the June FHFA house price index came in just a little shy of expectations as well, rising 0.2% instead of the 0.3 that was expected. So a couple of negative reports in the home construction area. And then finally at 10 a.m., August consumer confidence came out better than expected, 135.1 versus 130. So maybe a little bit of an offset there between the weaker home construction reports and then consumer confidence. 10-year Treasury yield, the Treasury market doesn't care. Money just keeps flying into this market, sending yields lower. It's been a pretty remarkable drop. I mean, we're already in a very significant downtrend even before August began. But when you consider we ended July over 2%, and we are now at 1.48%, that is a huge drop in Treasury yield. So we talked about financials earlier and the banks, life insurance. These are companies that really get hit hard when the interest environment is like the one we're seeing right now, the interest rate environment. So 10-year Treasury yield continues to drift lower, and that is going to be problematic for the market to do much to the upside, the equity market, as long as money is rotating into treasuries. As far as earnings go, there were a number of earnings reports out last night and this morning, and many of them you'll see on your screen there. Mixed bag, really. The banks were mixed. Bank of Nova Scotia beat. Montreal missed. You can see J.M. Smucker. We're going to show that chart here in just a couple minutes. But big miss there. Anaplan, PLAN, that's a software stock that actually had a really nice report. Beat on the top line, beat on the bottom line, raised guidance. And I think it's a great example of why, for me, holding into earnings, and I know I've talked a little bit about doing that with the portfolios because you've got 10 stocks and it's an average of, ups and downs among those 10 stocks. But if you're just looking at one stock to hold, I think Anaplan is a perfect example why it's so risky. Great report. And last time I looked, stock was down 6% today. But we'll look at that chart in just a couple minutes. First, I do want to pull up a couple of charts that I mentioned earlier, one being the food retailers and wholesalers. So let's look at what's going on there. I think this is a really nice, constructive looking chart, nice uptrend in play. And of course, when the market's weak, you tend to see outperformance by the defensive areas of the market, and food retail and wholesale is part of that. So big breakout here above this 480 level. I see an uptrend and a little bit of a cup here with a handle back to the 20-day moving average, and now we're getting a breakout. This is a group I think continues to look good despite the fact that the market overall is weak and that there is a lot of volatility out there. This is where traders and investors will go for a little safety, areas like food retailers. All right, next up, pull up the banks. Make sure we got an up-to-date number here. Right now we're sitting at 410, down 5 points, down 1.25%. I think it's pretty clear this is an interesting level of support that we really need to watch. Banks on the cusp of a breakdown, and life insurance looks to me like it is breaking down. It looked like a couple days ago we made the breakout to a new low, clearing the February, March lows, bounced yesterday a little, and now today we're right back down again. Unless we get a big reversal, I'd be careful here. There's a slight positive divergence. So if we could get a reversal, maybe we put a bottom in on this group and get a run back at least to the 20, maybe even all the way to the 50. But without that reversal, if it's another strong, heavy volume push to the downside, I think that is not boding well for this group. Individual stocks. J.M. Smucker. Here is what's going on today. You can see the stock currently down 9.24%, down more than $10. Look at the relative chart. I mean, we look at the food group overall here, not doing that badly. You look on a relative basis, we just set about a 7-month relative high. But this is a stock that's been an underperformer in the group. Why? Well, we found out why. Missed top line, missed bottom line, lowered guidance. So relative strength does help as you look at some of these stocks, especially as you head into an earnings report. Now, here's Anaplan. This is the one I was just talking about. Here, you've got software going up. Anaplan's been a great performer relative to the group. So my thought process going into this would be they're going to have a good report. The problem is, even if they have a good report, you don't know that that is going to mean or going to translate into a solid reaction. They beat on their top line, 84.5 million versus 78.3. They beat on their bottom line, and they guided quarter 3 and fiscal year 20 revenues higher. Stock down more than 6% today to test its 50-day moving average. Personally, I think this is an opportunity. On the long side, I think the stock continues to be a very strong relative performer, and it's in a great group. But holding into earnings, you just never know. All right, last thing I want to do, let's go to the dashboard here. I know among the large cap stocks, one of the top scooter movers, and there it is, Newmont Gold Corp, NEM. You can see up 6 points, almost 7 points on the scooter. If we take a look at the chart, I've got mixed feelings here. Number one, I do think that, let's try that again. I don't know why that's doing that. I don't want to do that. Let me do it. There's more than one way to do this. Let's go back and pull it up this way. All right, here we go. So, no, that's not the one I want either. All right. Just bear with me 1 second here. All right. It is still not on here. Well, I'll tell you what. This is what I'm going to do. Let's go with NEM. I'll show you what I wanted to point out here. I'm a little concerned about what's going on here. Here's the move on the scooter. So it is back up in the 90s, which is a positive. Nice uptrend. Looks like a little cup, maybe a handle breakout. That looks good. Everything on this chart looks good except the relative strength of the stock versus its peer group. The peer group has gone up about 50% in the last 4 months. This has been a nice ride, but it's only been up about 33%, which isn't bad, but there are better stocks in the group out there. So Newmont, big move to the upside, nice breakout. I think this is worth, if you're in it or looking to get in it, if it makes this breakout and holds, I'm okay with it. But if it fails and you leave a tail up above that 40 level and pull back, I would be a little careful because of the relative weakness versus its peers. But anyhow, this is a really strong performer today. For that reason, it is my scooter mover of the day.
All right, let's go ahead and move right on into some upgrades and downgrades. I'm going to start with Cree Incorporated. Cree was actually downgraded yesterday, but it is upgraded today. It was downgraded into a neutral position, and JP Morgan is upgrading it today from underweight to neutral. So although Cree was on the downgrade list and is on the upgrade list today, they basically moved it into the same area that they're both on neutrals at this point. The target that JP Morgan gave was at $45. So let me bring that down just a hair there. All right, so that's about $45. So this was the target it has set for it. Obviously, we're trading right around it. I don't like this stock. I would be out of it if I weren't already. Looking for it to go even lower at this point. The momentum to the downside is just crazy right now, and you can see that volume on the OBV is just really moved down quickly, mainly because, of course, you're subtracting these volume numbers from the previous day's reading. So it isn't a surprise when you see that kind of volume action and then get the OBV to drop this way. But this is telling you there's some serious problems. And honestly, if you go back here, and I'm going to use a vertical line. If you go right there, the 20 had just crossed below the 50-day EMA. So we were already getting some notice that there were problems ahead. It could have helped you get away from this. And then also, if you look here, the PMO had a sell signal back here on August 13th. And that would, of course, given you some heads up as well. All right, next symbol up is going to be EXC. Morgan Stanley has upgraded Exelon Corporation from an equal weight to an overweight. They have moved their price target up to $60 from $56. So it was right about here, and they've now moved it up even higher than that. I mean, I see a lot of good action here. One of the things that I did notice off the bat was the fact that it did break from a rising wedge, and those are bearish patterns. So whenever I see the pattern resolve in the opposite direction that we are expecting, I consider that especially bullish. And then notice we did have coming in this PMO buy signal. Oops, let's bring it down here. It came in, there we are, at about August 14th, a little bit after. So we had the buy signal coming in early as we were making this move to the upside. It looks pretty good here. The 50 is now going to avoid that golden cross, well, I should say the death cross of the 50 below the 200. So I think Exelon looks pretty good, and they're moving it into overweight for Morgan Stanley. Finally, last one we'll look at is Argus has downgraded Cardinal Health from a buy to a hold. There was no target that they listed. Obviously, you can see support is sitting either right here at that low, or you could bring it up just a little bit. And there you go at these two lows back here. I'm seeing sort of a double top formation, but those have to come off of a price rise. So I would look at this more so as a symmetrical triangle going on here. Symmetrical triangles are continuation patterns, so you should expect price to go in the direction that it fell into that triangle or broke out into that triangle. At this point, that symmetrical triangle, if it is a continuation, is saying that we should expect some more downside on it, so not a surprise to see that downgrade. And that's all I have for upgrades and downgrades. We will be right back with Tom's workshop on relative strength right after.
The ChartWatchers newsletter features expert technical commentary about the current market from some of the industry's leading technical analysts. See what's really happening in the markets through their eyes and gain an edge in your own investing. The newsletter is packed full of insightful and educational articles intended to help you become a better investor. Whether you are brand new to charting or a seasoned technical analyst, each edition will provide a wealth of informative content. It's the best way to stay informed on all the latest news, events, updates, and additions here at StockCharts.com. Whether it's a new feature or blog, an upcoming conference, or a special sale, you'll hear it first in the ChartWatchers newsletter.
All right, welcome back, everybody. And today for my workshop, of course, I talk a lot about relative strength. So I think this is a topic that always generates a lot of interest, and so I try to look at it from different angles. So I thought today what I would do is just talk a little bit about a process that you can develop in terms of identifying relative strength. I view a default system as the StockCharts technical rank. I mean, it's right here. It's already done for you, really. In Chart School, I've got the article up here on the page where you can go through and find how StockCharts ranks these various companies. I think it's really important to understand how they're ranked. If you're looking for a stock that has shown tremendous relative strength over the last 5 years, the scooter might not be the best place to go, because if you just go through the formulas, you'll find that a lot of the calculation is based really on the last handful of months, and doesn't really go back years and years. So if you're looking for a company that's going to show high scooter score. I mean, obviously Apple's been a great performer for a long time. Amazon, great performer. But if they go through a period of 5 or 6 months where they're not performing well, their scooter rank is going to drop rather significantly. So you have to understand the parameters that are set by a particular relative strength system. So here, just understand that the scooters, when you start looking at these, I think they're an excellent way to at least initially begin a process. But just keep in mind that this is really based on a very short to intermediate term strategy. So that's the first thing I would say. Now, if we go into the dashboard and you start looking at some of these scooters, and I'll just go right down under member tools, and you can find that under reports and analysis tools, here are your scooter reports. And what this is going to do is it's going to break these stocks down between large cap, mid cap, and small cap. And if you want to look at ETFs, if the ETFs are your thing, then that's going to break it down. Or if you want to look at a couple of foreign areas, that's there as well. But if I was using it, because I do concentrate on individual stocks here in the US, I would be looking at large cap, mid cap, and small cap stocks. Now, one of the problems with the way this is set up for me is I like to trade some of the best stocks within the best industry groups. Now, if you look at here, you're just going to find the rank in order, which is very helpful, but it is looking at it can be a stock in an area of the market that's not performing well. That can be at the top. So for instance, right here, large cap stocks, market access holdings, investment services. If we just pull this stock up and I pull up a relative chart, you're going to see this stock's been a great performer, and relative to its group, it's been a great performer, but the group itself has not been so great. That's important to know, in my view, because if a stock starts to lose its luster to the upside, and it's part of a group that's been an underperforming area of the market, I think that's got a lot of risk in it. And so I'd probably want to keep a tighter stop. Whereas if I've got a stock maybe that's in a different area of the market, and let me take a look at something else, find a good one here. Food products. I mean, we were just talking, food products isn't bad, even though it's been in a more defensive area. Let's pull up Hershey's. So Hershey's one of the top performers. Look at this chart. Looks pretty good too. But the difference here, in my opinion, is that now you're getting a stock in an area that just went to a 7-month relative high. So you might say, well, it's down from where it was last November, and I could certainly find another industry group that would be even better than this one. But I could at least point to the fact that this is a group that is now at a 7-month, or was just recently at a 7-month relative high to the S&P 500, and Hershey's is one of the best stocks. So I think there's a couple of components to this as you try to identify a process. It's more to me than just one stock that's been outperforming. I think part of it is also trying to find areas of the market that are outperforming, because if the area has been outperforming and then a stock is outperforming within the area like Hershey's, it's going to take 2 steps for this company to begin to lag. Number one, if the group continues to be strong, Hershey's might still pull back relative to the group, but still outperform the S&P 500 because its group is so strong. Or it could, have some potential, or it could continue to be strong, but its group could lose a little bit of luster, and it could still be such an outperformer versus its group that it continues to outperform the S&P 500. So there's really 2 prongs to this that I think is really important. And when you have the best stock within one of the best groups, the chances of that stock continuing to outperform the S&P 500, in my view, is better than if you have a stock like I was just showing you in investment services, like MarketX Holdings, because investment services hasn't been a great area of the market. So now I'm counting only on the relative strength of that individual stock. So again, that's just the way I look at it. You can look at it completely different, and everybody does look at it differently, but I think relative strength needs to be a part of your a part of your strategy. All right, let's move down to restaurants and bars. This has been a powerful area of the market. So we just talked about food products moving to a 7-month high. Let's pull up Chipotle. This is a stock I own. Chipotle making another breakout today. If I pull it up on a relative basis, you'll see that we continue to trend higher. The restaurant group continues to trend higher. Chipotle, relative to its group, is now breaking to a new 52-week high, probably an all-time high. Relative to the S&P, it's clearly breaking to a new all-time high. And the restaurants, see the difference here versus food products, and certainly versus investment services? Now, all of a sudden, you've got this big move up in restaurants on a relative basis, and Chipotle is one of the best stocks. Today, the market, last time I looked, was down, and yet here you have a stock that's continuing to go higher. Why? Well, it's one of the strongest stocks within one of the strongest industry groups in the market. I don't argue with that. I just hopefully can tag along for the ride. And so that's the way I use relative strength. So no matter what your system is, there's going to be some limitations. There's going to be some very good things about it, but there's also going to be some limitations. The StockCharts technical rank, again, is an excellent way to quickly identify areas of the market and in particular, individual stocks that are performing and outperforming some of their peers based on market cap. So here you've got the large cap. You can scroll, you can go down and get the mid cap. Now, of course, before you come into large cap, mid cap, or small cap, it kind of makes sense to know which of those three areas are performing well. Because I, again, want to have my money where I think it's got the best chance to work its best for me. So if large cap stocks are outperforming mid cap and small cap, then large cap is kind of where I want to emphasize my holdings. And small cap, you can make all the arguments you want for it, but small caps have been underperforming for quite a while. And you can still find some great small cap stocks, don't get me wrong, but I think they'll do even better when the money begins to rotate more towards small caps. So here on the mid cap list, look at the top one, Roku. I was talking about recently computer hardware. I think computer hardware is just beginning to really strengthen relative to the S&P 500. I own Roku. Shopify, I did own. I actually got out of that recently and switched over to AYX. But these are both companies that have performed extremely well. So let's pull up Roku. What's encouraging about that stock? Well, again, let's flip to the relative chart. Roku continues to move higher today. It is up a little bit. It's off its earlier high, but still performing extremely well. Great volume trends. And you say, well, computer hardware, though, is not really broken out yet. You know, where are you seeing that strength? Look at the relative strength. It's been rising now for the last 3 months. So when you look at its absolute strength, it might not seem that much, but it's been better than the S&P 500. So if the S&P turns higher, you know that you've got more money, at least right now, rotating into computer hardware. So this is a space that I'm pretty interested in. Look at Roku relative to the computer hardware group, and look at it relative to the S&P 500. In order for Roku to really begin to deteriorate, we're either going to need to see computer hardware underperforming in a big way, or Roku underperforming computer hardware, or both. And again, the chances of both happening, in my opinion, are not that great, especially if you have a portfolio of stocks like this. So Roku is part of a portfolio. It's part of the model portfolio that I have at Earnings Beats. And this is why I like these stocks that show great relative strength in groups that are beginning to show a lot of strength as well. Now, when you go into the small cap, again, you're going to find some stocks at the very top. Enphase Energy, this is one in my aggressive portfolio at Earnings Beats, and it's pretty much the same thing. We click on the chart, and we go to a relative chart. Here you go. I mean, it's going up, heavy volume. Look at the group. Renewable energy is the best group in the market in 2019. It's been the best industry group. And then look at Enphase relative to renewable energy and relative to the S&P. It's been a huge performer. So the more of these relative outperformers that you have in your portfolio, the better off you are. Does that mean that every one of these stocks is going to continue to go higher? Of course not. What you're banking on is that if you diversify into different industry groups that are all performing well, and you have leaders in those industry groups, you're hopeful that not all 10 of them are going to fall apart altogether. If we go into a bear market, yes, some of these are going to get hit hard because they're growth plays. They're going up because of the anticipation of higher earnings. So you need to be aware of what your risk tolerance level is when you're going through and setting up a relative strength strategy as well. If you go back here and you say, let's say, okay, I kind of think the market might go higher, but I'm really nervous about the trade war. I think the market, is vulnerable. We're going into September. That's not a good month historically. Well, there are things you can do. First thing you can do is just type in Staples. Now, these are small cap stocks, but if I type in Staples, all of a sudden I've got the highest scooter ranked stocks among small cap consumer staple names. And if I want to make it large cap, just go back to the large cap. Hershey's right on top, one I just showed you. Estee Lauder, been a great performer of late. This is in a different area, personal products. Costco breaking out, I showed you earlier. Personal products. Let's see, Coca-Cola has been performing really well. Soft drinks, another staples area. So there are things you can do, all right? Not convinced there. How about real estate? So you got the real estate sector. These are ranked in sector order. Let's go, or in scooter order. Let's take a look now at SBAC. Let's pull this one up. You know, a lot of these staples names, by the way, and real estate names, they pay dividends too. So not only are you seeing, look at the relative strength here. You don't have to take all the aggressive names. You can go with more defensive names. But why would you want stocks that are underperforming the S&P 500? If you're a value investor, sure. You know, but you've got to wait to unlock that value. How long is it going to be? Is the value going to be unlocked in the next 30 days? Maybe. Is it going to be 6 months? Maybe. Might it be 3 years? Maybe. The idea with relative strength and following relative strength is that you're looking for that momentum now. You're not trying to catch a bottom. So SBAC, there's just a lot of different ways you can look at relative strength and identify a process that works for you. All right, one of the things that I like to do, first of all, is get a general sense of what I think about the overall market. And that is going to help me determine, do I want to be more defensive or do I want to be more aggressive? In my blog this morning, I wrote about why I'm bullish. And I said at the open today, I'm still a little nervous in the near term. Volatility is around 20. If we break those lows in August that have been holding, we could see a quick 150 point drop on the S&P 500. Would not surprise me. And it's because the market is irrational. When the volatility index is up in the 20s or jumps into the 30s, you can argue PEs, you can argue, well, you know, relative, you can argue anything you want. The stock market panics and the people who own stocks panic. It's a very emotional market and you can't really stop it. It's like jumping in front of a freight train. So you got to keep your stops in play from a short-term trading perspective. When I look at the market now, what I see is under the current outlook, I pulled up the S&P 500 and I looked not only at what it's been doing over the last 15 years on a weekly chart, but I also looked at the relative strength of the 5 aggressive groups. And if you go back to 2007, when we broke a trend line here and the PPO, weekly PPO went negative on this break, I want you to take a look at what the relative strength of the sectors were doing. Technology was getting crushed. Consumer discretionary on a relative basis. Look at this. It had been dropping for 3 or 4 years. There was no relative strength in consumer discretionary. Communication services didn't start that until 2007. Can't really look at that. Industrial's not doing badly going into that. But look at financials. Really, industrial's the only aggressive area that looked even reasonably strong as we were making this breakdown in the overall market. And even leading up to these highs back in 2007, technology looked good, but consumer discretionary didn't. I mean, you would think with the S&P 500 at an all-time high or close to an all-time high back then, that consumer names would be doing really well. That was not the case. Completely different signal that the market was sending us. Let's fast forward to 2016 when, I was a little nervous. I was nervous with the volatility index jumping. I know among consumer stocks, staples were outperforming its discretionary counterparts and so forth. But if you take a look back at when we were right on the verge of breaking down in January of 2016, technology had broken out to a new relative high. That certainly didn't look bad. Consumer discretionary just had a huge run up in the second half of 2015 and barely budged to the downside during this sell-off. All this selling, second half of 2015, consumer discretionary names were not being thrown out. Then you go into communication services. That look bad? I don't think so. The only 2 areas that I think looked bad or even partially bad were industrials and financials. And industrials still were putting in higher highs, higher lows. And financials really didn't look overly horrible. So when you look at what's going on in the S&P, it didn't really make sense when you look at the story under the surface. And so the same thing, look at the December low in 2018. So right here, we come down, and essentially this line, by the way, the reason it's connecting these two lows is if you connect these two highs, I just dragged this line down. It's the same slope. So using the highs and connecting this big low back in 2011 didn't quite touch the 2016 low, but it touched that low in December 2018 perfectly. So we remain in the channel to the upside. Yes, technology got hit in the fourth quarter, but the overall uptrend, I mean, I think this looks completely different than maybe what we saw back here. I think after a huge run up to the upside, this to me is reeking of a secular bull market, not the secular bear market that we were in before. Money is pouring into technology. And when we went to the new high, first of all, we never got to a new high back in 2007. Here we did. So everybody thinking that that was bear market, that goes out the window when you set a new high. And on that new high, money continues to pour into technology and consumer discretionary. The only two groups that hit a relative high, only two sectors that hit relative highs in 2019, technology and consumer discretionary. All right, communication services, not great, but certainly not horrible. I mean, I think there's still an uptrend here in play. Maybe call it consolidation. Industrials and financials, again, the weakest, but could I argue that there's still an uptrend in play? Yes, and I would. Financials, is there an uptrend in play? I think so. I think these are two areas, financials and industrials, I think could lead, and we might see a pullback for a while in these other two areas. How could that happen? Well, if we start to show any kind of economic improvement and all this fear leaves the market, especially if a trade war is negotiated or is taken out, there's no longer fears over the trade war. I think you're going to see money rotate very quickly out of treasuries. That's going to send the yields higher. What's going to lead when the yields go higher? Financials and industrials. I'm not writing them off yet. I'm just not interested in jumping in until they begin to show strength and until the other markets, treasury market, begins to tell us it's okay. All right, so I believe we're in a secular bull market. So how does that impact me? Well, when I set up my relative strength strategy and process, I want to look for those aggressive groups. I'm not a believer of a bear market. If I think the market's going higher, I want to use relative strength in strong areas, strong aggressive areas of the market to line my portfolio so that when the market bounces and moves to a new high, my portfolio jumps more than the S&P 500. So how do you do that? Well, I have a chart list that shows relative strength of sectors, which we've already talked about. And then I also have a chart list of relative strength of industry groups. And here they all are. I got them all listed, and I've got the technologies first. So I'm going to concentrate on those. Just talked about computer hardware. Let's take a look. On a relative strength basis, here's computer hardware breaking back out above its 20-week moving average. This is a relative chart. Computer hardware divided by the S&P 500. This isn't telling us that computer hardware is going higher. It's telling us that it's outperforming the S&P 500. The relative PPO, this is relative momentum, is positive. When the relative momentum is positive, I'm much more interested in a group. We're now seeing that 20-week moving average crossing above the 50. Look at what happened when the 20 is above the 50. We had a period of a couple years where you wanted to be in computer hardware. We went through a period recently where we didn't necessarily want to be there. I think we're getting back into one where we do want to be in computer hardware. So when I look at computer hardware, I just mentioned Roku. So let's pull up Roku. Talked about this one earlier. But I mean, this is how I would go through my whole process. I'm a secular bull. I believe the market's going higher. So I want to stick with the aggressive areas of the market, the aggressive sectors. Technology, consumer discretionary are two big ones. They just broke to new relative highs. And then I want to find the groups within those areas. And that's where a lot of my investment's going to be. And you might say, well, you're not diversified. Well, I get back to what I'm going to paraphrase, but Warren Buffett when he was talking about diversification, he said, really, it's a form of ignorance, because you're putting a lot of your money into an area of the market that's not working. I want money diversified in a way, different industry groups, different stocks, but I want them all to be working for me. And so that's just part of my strategy. Now, Roku, yes, today, right now, it's down $1.39, and it's not like it goes up every day, but I think when you're looking at the relative strength, I don't think there's much argument. This has been a great performing stock. If you're trying to beat the S&P 500, Roku is a great way to do it. Roku has been in a portfolio of mine since back on May 19th right here. And I think you can see relative to the S&P, it's been a great performer. I mentioned Chipotle earlier. Pull this one up. Again, this is just another individual stock that kind of meets that whole criteria. Restaurants, which part of the market is that in? Consumer discretionary. Restaurants relative to the S&P 500, exploding to the upside. Chipotle, relative to restaurants, great performer. Relative to the S&P, great performer. Another one, how about Starbucks? In the same space, relative strength across the board, strong. Want a third one? Shake Shack. Shake Shack, big earnings report, continuing to move higher. Relative strength off the charts. Those are just three quick names out of the restaurant area. And many of these, by the way, you would see on the scooter report that I showed at the beginning. But that was just a little sense of what I do to try to establish and identify my own relative strength process. Everybody's different. You got to find what works for you. And again, maybe some of you are value investors and relative strength means nothing. You might be looking for relative weakness because you're trying to find stocks that have a tremendous amount of value and you're willing to hold them. Maybe they pay nice dividends and you don't care if for the next year or two they're down. You think long-term they're great investments. That's a different trading style, certainly a lot different than mine, but it doesn't mean it's wrong. It's all in what works or fits in your own trading strategy. So that is it. I'll bring a summary up, just a few things that I talked about here. The scooters, again, that is a great default strategy and process right here at StockCharts. What I would simply say is that there are a couple of limitations. Number one, the scooter, go back and look at the formula. It only goes back probably 5 or 6 months in terms of comparing relative strength. So you can look at gold, which has been, I showed you Newmont Gold Corp earlier. That was the scooter mover of the day. Remember, it's over 90. Well, that's because it's looking at the last 5 or 6 months. Gold's been great. If you were to look at a longer term chart, I think you'd probably agree gold has not been a very good area of the market on a relative basis. So know what it is that you're looking at. That would be the first step, scooters. Sector relative strength to me is incredibly important. I have no interest in looking at energy and materials with one exception. In energy, we know renewable energy has been the best performing industry group. So I'm not going to ignore that just because it's part of a sector that's not performing well. So, but there's no area in materials right now that I'm overly excited about. Short term, yes. Gold mining, the miners in general, they're all doing well. But from the way I look at the market, a little bit bigger picture, that's not a group yet that I think's been strong enough for any period of time. So that's not the way I look at it. So you drill down from sector to industry group, and then industry group finding stocks to meet your individual goals. That is it. And now it is time, if you're ready, Erin, for the
I am very ready. Okay. That was a great workshop, by the way. I'm sure everybody was happy to see that.
Yeah, I enjoy sharing the relative strength. I mean, we've had so many guests on here. Of course, we talk about it a lot. You've got your RRGs. That's another great way. I mean, I started with scooters, but another great way to show relative strength is with the RRGs. That one you have to kind of key in your own data and so forth. So it's a little bit more time consuming than simply going to the scooter, which I think is a default. But you can see with the relative rotation graphs, that shows great relative strength picture versus whatever benchmark you choose.
Absolutely. All right, so I did get these obviously into an RRG. We're looking at it. We had really heavy on technology. We had quite a few voted on as most popular, so lots of ties out there. So you're going to see a lot of those popular symbols in there. And I know that the first one is going to be DBX. So I'm going to go over there right now and put that in. Let's see, I'm running scans, having fun with that. All right, so annotate. There we go. DBX Dropbox. Clearly not doing well for the past month. It's really been a bloodbath. Let's go ahead and look at some of the support and resistance. You know, this area of support, I'm going to line that up with that previous low back in June. And it does somewhat match up with some tops back here and some lows, but and these lows. So that's when we really knew there were some problems going on. But we were already, again, given warning back here when the 20 crossed below the 50. And if you come all the way back here to when we got the sell signal on the PMO, again, you're getting plenty of warning before these happen. Now, of course, the question is, and I'm sure that's the reason it was requested, is what about now? Is this the time? Well, I'm gonna save these annotations the way they are because I want to look at a weekly chart real quick, and then we'll move on. Oh, actually, I don't need to save these. Okay, there we go. So what I want to do is look at the weekly chart. There we go, DP weekly. Oh, well, see, it's rather new. So it's trading at its all-time lows. There's no way to really pick the bottom at this point. I mean, it's at $17.50 and it already broke down below those 2018 lows. So I wouldn't be interested in this at all until it started to show some kind of movement to the upside. Yes, if you want to try and catch a bottom, maybe this is it, but I don't like to play on that. So, all right, next one looks to be KMX was one of the most popular, so I'm going to do that one. And we'll take this and make this a daily chart if it isn't already. Yeah, it is a daily chart. All right, so first of all, the handy dandy auto support resistance tool. Where's our high right now? Back here in late July. Where is short-term support? It was right here. We're losing it. So where's the next area of support? Well, of course, you can look here at the 200-day EMA, and that lines up pretty much over here where we were in this trading zone back here. So I would be looking, you can see it's already starting to trade below that top we had back in May. I would be looking for it to fall further. You can see that the PMO is moving negatively in a way that you don't want to see. It gave us the sell signal back here. Granted, if you had gotten in here, you might have lost here and you would have certainly missed out on a rise. But overall, it was really moving sideways. It's formed kind of a little head and shoulders here. And then I'll move on to the next one. There we go. And it's gotten below that confirmation line, size of the pattern, add that to the bottom. That gets you at least down to this area of support. So I would be looking for more downside on CarMax.
All right, next one is Rubicon project, RUBI.
All right, this one I remember was pretty popular in the chat room. All right, well, PMO sell signal right there. So remember, these can come in nice and early to give you some warning. I would be looking at, let's see, right here. I would look at this as an ascending triangle, and that's, you know, that's a bearish pattern. The expectation is a breakdown. And here we are getting ready to test the rising bottoms trend line, the bottom of that rising wedge, and the 20-day EMA. And this is all coming on a PMO sell signal. I wouldn't be wanting to get in here. If I were holding it, I might, you know, I would look at this a little more closely. Maybe if it does get down to the 20 and maybe breaks below, then I would sell. But I think this is giving you pretty good warning that something bad or even something boring is getting ready to happen. You can see back here, it was just really right before that sideways movement. So I think there are better candidates out there. I wouldn't buy it. I would actually start considering selling it at this point.
All right, next up, Home Depot, your fourth stock, HD.
All righty, there we are. And annotate. Oh, it's had a nice breakout here from overhead resistance. It's now formed a new short-term top. I think if you look at this, you could make a case for, let's make this a little bit more clear. I think you could make a case here for a rising, a bull flag. And if we get the breakout above, I would say that the top of the flagpole here, I would start looking for a move, a very nice move to the upside. We have the PMO buy signal here coming in rather than like we were seeing before, a sell signal coming in overbought territory. This is coming in just above the zero line with that buy signal. I think this looks pretty good. I would, if I owned it, I probably would just hold on to it until it started to get close to this low back here at that 200 or 195 level for an intermediate term trade. Basically watch this rising bottoms trend line right here.
All right. Next up is Pilgrims Pride Corp, PPC.
All righty. Yeah, we got to move on through, huh?
Yeah.
You're really good at keeping these moving. So I get so into talking about a chart, I could just do it all day long, which I kind of do. All right, so there is support right now. Let's make that a little thinner so we can see the rest of this price movement over here. And you can see it's now acting as support, and it's right near the bottom of this. We are seeing the PMO turning down, but I wouldn't be so concerned about that because overall it is moving upward with the upward momentum of the price rally going on here. And you can see you can sometimes get these false tops, as long as we're still in a nice rising trend on the PMO. And you can see even with OBV, we're still looking fairly good. That could be a little bit of a concern right there, but we're pulling back. We're starting to digest that breakout, and so I would be watching that 20-day EMA, of course, for your support in a very short-term trade. The 50-day longer-term trend would be what I would be paying attention to now if I were looking at an intermediate term picture, is this rising bottoms trend line here. So for your more intermediate term trade, just you want to keep that rising bottoms trend line. You want to see that trend continuing higher.
All right, Activision Blizzard, ATVI. ATVI.
Right. Here we go. And interesting. Nice breakout today. It'd be interesting to see where it closes in that price range, though. All right, so we have been really in a trading range, and I think you could just make it this large here. Let's make this thicker so I can see it. All right, so here's your trading range. And it's been, and I'm going to make this one a bit thinner, it's been really stuck at this level. It did make an attempted breakout late in November of 18, and that came in on an oversold move to the upside on the PMO. And we didn't get the buy signal until here. And, momentum, it seemed, was building, but we were really not moving anywhere. And that, I think, is part of the reason it was still below the zero line, and why you should probably pass on those that do show these very oversold buy signals, because sometimes you can look at this trading zone. But the fact we're breaking out here, if we close above it either today or tomorrow, that would be fabulous. You're seeing it right now trading above that 200-day EMA, and we have not seen that kind of action since, back in October of 2018. So I think this one's looking pretty good on the breakout. I would consider that a buy, and certainly if you're holding it. Look at the scooter, too, moving into the hot zone. Very nice.
All right, eHealth, EHTH.
Is this your Monday setup, or was this one before? I can't remember.
Nah, VIPS. It was one from before. I actually talked about it on Monday. I liked it. Actually, got stopped out of it myself. But yeah.
Right, because it was on that very interesting support level. Looks like it was going to hold up. And then we did get that failure. So where's the next dropping point? Where should we look? And it's trading below that 50-day EMA. So if I were in, like you said, you got stopped out, I would definitely be looking at getting out of that position personally. And I would have been reconsidering it back here when we had that PMO sell signal and that very accelerated move toward the downside. So I think that was, again, our warning. And the 5 crossed below that 20-day EMA, gave us a little bit more warning, but I think this is the big problem. Trading below that 50-day EMA really would bother me.
Yeah, and I also use this as I actually have a stop buy if it goes back up above 94, because I think this could be a bottom, but
Yes.
I'd want to see the reversal first. So this is one that's going to be a pretty interesting play into the end of the day. All right, only a couple more minutes here.
Yep.
EW, Edwards Life Sciences.
Okay, we'll just look at these really quickly. My first, that's you notice I was like sighing the very first thing I did, because I think I just have eyes at chart patterns, but I could see kind of a complex head and shoulders in the process of building here. You've got a PMO sell signal going on. You're trading right around that 20-day EMA, not so sure you'll hold it. I wouldn't be looking at this as an entry point for a stock. It's, if I owned it, I'd still hold it. I think you've got this gap to be concerned about. It's really looking like it wants to come back down and cover that gap. And if this turns into a sort of a messy looking head and shoulders, but it's sort of giving me that look. So I would be holding it, wouldn't be buying it. That's kind of where I'm at there.
Great. Sherwin-Williams, SHW, 2 more.
All righty, almost there, almost. There we go. Holding at that 20-day EMA, of course, I always get a little bit worried when I see these sell signals in overbought territory. I think it's really an attention flag right now. If you owned it, to pay closer attention, I would be looking at the next area of support, of course, is back down here. And again, what I watch for on an intermediate term trade is the rising bottoms trend line. I want to keep that rising trend. And at this point, we're still there, and you've got, all the way down to your 200-day EMA. So in an intermediate term trade, I think you're just fine. In a short term one, just watch 490.
All right, 30-second take on GLD. What do you think?
GLD, I talk gold forever. I am still a gold bug. I'm very excited about gold. And in fact, I'm just going to cheat, and I'm going to go to my gold chart here, and I will just change it into GLD for us to look at. And there you go. So that is with GLD. I mean, it's been on a great run. We're still seeing discounts on the physical gold trust. That means we're still seeing some bearish activity there. I like this PMO bouncing off the signal line. Yes, it's overbought, but it can stay there for a while. I'm looking for gold to continue higher.
All right. Good job. And that is your 10 in 10. Might have been
I did it.
12, but you did great.
Thank you.
You did great. We are going to take a quick look at that poll, though, because we only got about a minute left in the show. And the poll question, and I wanted to make sure it was clear to everybody. This was, should the Fed lower rates at their next meeting in a few weeks? Not will they, but should they? And so I'm really interested to see what do you think, Erin? Do you think they should lower their?
I think they should, just because of what's going on globally. I think it would help. I mean, you and I both were talking about how they should have lowered it more the last time. I think this is a shot in the arm here that we need.
Yeah, I would say that I think they need to. I think inflation is lower than what they want. It's below the 2% rate. And I think if they don't lower, I think it's going to strengthen the dollar, which in turn is something that helps to weaken commodities and could even increase that push to the downside in terms of inflation. So I think they really need to, and I think it would be good also with the trade war issues.
Yep, absolutely.
All right. Well, that is it. Do want to thank everybody for joining us today. Please remember to complete the survey as you exit, located below your video player. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays, from noon to 1 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everybody. We'll see you back here tomorrow. Happy trading.